Okay, it's 6 o'clock. Welcome, everybody, to the first due diligence session of our due diligence boot camp. If you recall, last week was just reviewing TAM, SAM, SOM, and pitch decks. And tonight, we're so pleased to have Craig Macy, who is part of the practice that represents Startup NV. He has been a longtime startup attorney, seen it all. And he has a great sense of humor. So he's going to go over the due diligence aspects that we're going to cover in AngelNV Due Diligence. And so corporate and finance aspects. No, corporate and legal aspects. Sorry, Craig. All right, Craig, you can give yourself a more thorough introduction. Take it away.
Okay. All right. So I guess the first thing, maybe I'm going to have to switch a slide deck really fast, but my understanding of topic was to go over terms in term sheets. Is that not what's expected?
Okay, well, maybe you can throw some corporate and legal stuff in there too.
Well, there'll be a lot of corporate and legal, but I have a different deck. I have a due diligence deck that I do talks on, so I could swap it if the topic's different.
Are you prepared to do that?
I don't really prepare. I just talk to the stuff that I've written. So I'm sure that I am. You just have to give me a minute to see if I can find the deck real quick.
Okay, and if you can't, then term sheets and term sheet terminology is fine. And so for everybody who's joining now, if you're in the room in Las Vegas, if you have a question, you can wave Erica down and she'll bring you a microphone so that we can hear you online. Otherwise, if you're online, you can put your questions in the chat and I will interrupt. And if it's a clear enough question, I'll just read it. If it is complicated, I will have you unmute and ask the question yourself. And so Craig said he'd like to do it so that things stay in context, but he says he also has a tendency to go long. So yeah, be brief in your questions, like just efficient. Here comes Lucy. Lucy was here and then she left. And Craig did send me the term sheet terminology deck earlier, so I will include that with our assets that we send out through Disco. All right, there's a question. Does AngelNV invest in entertainment startups? So Tristan, AngelNV is the most egalitarian program that we have because we're gathering and teaching new investors. And so they're voting every step of the way. So it's not like the investment committee for FundNV where they have a particular thesis that they're following. It has more to do with what the angels as a group decide to do. So you have a better chance of getting an investment as an entertainment company through AngelNV than any of our other vehicles. There is no check-in for this class, Brian. Did that answer your question okay, Tristan? Okay, good.
Okay, so I found the due diligence prezzo from, actually this one isn't too long, from a couple of years ago. I could do that.
Okay.
Or I could do the one I sent you. I'm super flexible. So
Why can you shorten up the terms and terminology and then go into due diligence, or should we do it the other way around?
let's do it the other way. Well, from an order of events, the terms and term sheets come before due diligence. And due diligence is a point that I make. Maybe what I'll do is I'll try to combine it. And so I'll go through the terms. I'm gonna cut my long-winded discussion of the specific terms down. And maybe what we can do is I can talk about term sheets, a little bit about how that game's played, and there's a point to that relating to due diligence. I can go over the due diligence stuff and maybe get a 2-for-1 as long as I don't get too long-winded. That might be the best way to do it.
Okay, go for it. Sounds good.
All right, let's try it. Worst that can happen is I run out of time. Wouldn't be at first. Okay, so I'm going to share. All right, is it all visible?
Yes, looking good.
Great. Okay. And I'm going to do something here so I can see what the time is. Maybe yell at me at 6:45. Just let me know that it's 6:45. I'm going to try to watch the clock. But,
Okay.
All right. So what we'll do is we'll go over these things called term sheets and the language that's involved with all of that. But I'm going to go pretty broad and talk a lot about the term sheet exercise and the financing exercise. I liked this quote. I just found it, although I cut the first part off on purpose. The first part of it, to be fair to JFK, was you can't negotiate with somebody that thinks. And what's mine is mine and what's yours is negotiable. Although I would suggest there's plenty of investors out there that's exactly what they think. So from a company perspective, sometimes that's what you're facing. So this is the traditional legal disclaimer. Basically, I'm here to teach, not to provide counsel. So I like to start out these talks with something to give you some reason to actually listen and think that maybe I'm not making stuff up. So this is a sort of a bulleted item history of stuff that I've done. And you can rest assured that everything I tell you has an anecdote behind it, or 100 anecdotes, and is not something that I pulled off of the internet or ChatGPT told me to say. So, all right. So going into this, you want to keep all of these things in mind, and I'm going to talk quickly through them because it matters. One is, do you offer the investors a term sheet or do you ask them for theirs? And it's circumstance and situation specific. Sometimes you go out there with your own term sheet. Sometimes they bring theirs, and sometimes you ask for theirs. It's very specific. These are things, and it'll be true of a lot of the stuff in here. If you've got good mentors and you've got good counsel, they'll tell you what to do. But I'd say more often than not, you're putting your own together. Another thing you have to decide is what stage in the discussions does that term sheet show up? Too early can commit you to things that aren't maybe what you wanted. And if you wait too late, then you may be coming in with an ask at too late a point. So you have to be sensitive to that. Again, advisors help you through it. The terms you should include and how detailed you go is always really tough. Term sheets can be super thin, or they can be full of more nits than you can imagine. And again, it's somewhat circumstance specific about how much you put in. Well, there'll be some stuff we talk about that very specifically goes to that process of folding things in, but it does matter. And it's another one where going too far can kill a deal and going too short can cause problems later. Something you have to learn, you can get it from counsel, you can get it from advisors, or you can get a lot on your own, is all of these terms that go in there. There are standard terms, there are market terms. And when you deviate from that, it can either cause problems for the deal and or make you look like you don't know what you're doing. And part of the term sheet is supposed to be a bit of an advertisement that you have a clue to someone you're trying to get money from. So it's relevant to know that, and it does change somewhat over time. Some things are pretty fixed, but to know whether or not you even can ask for something. Example I always give, and I'll come back to it a few times, is if you think you're going to get super voting rights, you need to think again, that's not a standard market thing to ask for, and it has other problems with it. But probably 9 out of 10 companies I've represented are like, I want super voting rights. And that's just not part of the game. It's an illegal move. Then you need to know what's fair to ask for. You need to know what you can push back on. You have to, and this will part of what we'll get to due diligence, you have to know how much you can give up early in information and how much you're not going to give up. And so if you give your investor a free look, then that can cause problems because the term sheet is what's going to anchor the deal. So it's kind of like, well, I want to tell them what I have to get them to the table, but I don't want to give them a look at everything. And so some investors are very smart and very aggressive about this, and they will try to get halfway through due diligence before they cut a term sheet. At some point, you have to draw a line and say, no, anything more requires a different NDA and a different phase. We're done with this phase. Do you want to do a deal? Another one is a joke of a thing that I put in here is how can it be made positive and constructive for everyone? And good luck with that. So keep it in mind, but it often gets very goofy, and it's constructive. You think it's constructive when you get the money, but there'll be other aspects throughout the process. It's its own challenge. And then one that's a nasty problem, and you don't really think about it too much, but you need to before you get into both the term sheet and in particular the due diligence component, is the risk of exposing your competitive advantage and competitive information. And the farther along your company is, the harder this is, because they want to see customers. Depending on your type of investor, if it's a strategic investor that's in your space, oh, well, we're going to let, Intel put money into the company or something. And giving them information could put you in a tough spot for them trying to effectively take a piece of your market. So this is always a tough one, whether it's your financials, which you don't want to expose, but you have to, or other elements of your technology or your customers or your deals. It's something you're sensitive to, but it's hard to control. So you keep all that in mind as you go through this and through the process as a whole. But first, you got a bunch of big decisions to make before you even go out to get money, to do these term sheets, to get into due diligence. And I don't have to read them all out to you, but it's this question of whether you ought to be taking money in the first place. And it's super important to get in your head, if it's not already there, that taking money is not a good thing. And start with that as a way to look at it. It is like filling up your car with gas. That's how worthwhile it is. It's going to get you somewhere, but it has a cost. It smells. It has lots of consequences after the fact. Who you get the money from, just like who you get bad gas from or something else. Who you get it from, the nature of the deal, the nature of the money in some types of businesses it's necessary, but it always comes with baggage. It comes with new people, new stakeholders, new interests, all of that. Don't believe for a second when you hear the term, oh, well, they're smart money. That's one thing that's like a made up thing that VCs came up with in the late 90s. They started calling themselves the smart money so they could get their money in. But smart, dumb, whatever, that's just a bunch of noise. And it's money, and whether or not you win or lose on the terms and whether or not these people are dastardly or not is all it comes down to at the end of the day. The smart part is cute, but that is not relevant to your decision. All the other things are. So winning matters. Winning in this term sheet exercise and this financing exercise is key, because when you're done those terms, you'll have lost a certain amount of control, certain amount of governance. You'll have requirements. It's going to change if and when you can ever exit, how much money you can make. So winning in this game is pretty relevant. It's, again, getting the money and going, yay, is not any good if the terms don't back that up. So to get there means you got to know the concepts, the language. You have to understand the game, what the rules are, what the moves are, what's standard, what your opponent's like, all the costs of the terms that you're going in and giving up. You mess that up and you'll strongly regret it after you take the dollars, and you are not able to backpedal. I have lots of clients. Maggie and I were just having this discussion that they regret the terms and they think they can go back and revisit it. So they get some lawyer to go try to push you around. It does not work. The deal's the deal. And if you made a mistake, you're stuck with it. So everything that I'm going to blow through in here is in this book, and probably 10 times better in this book. Everyone should read this book. Yeah, every lawyer I work with, and have worked for me, I've told you got to read this book. It's still the Bible. It's a little bit dated now, but it's the Bible for understanding these deals, and including due diligence. So you must get the book, you must read it. And if you don't, then you get what you get and you can't throw a fit, for my kindergarten teacher. So, but now there's a new book I throw in here. And I don't know if anybody saw The Goonies. It's this really old movie with this character in it called Chunk. Well, he became an entertainment lawyer, and a really good one. And he wrote what I'm going to argue is the best negotiation book there is. It's way better than that book written by that terrorist negotiation guy that just tells you to ask open questions. And it's better than the getting the yes guy. I'm not trying to get you yes, I'm trying to win. So this book's great. Get it, read it. It's short, it's easy, it's cheap. It's very aggressive, but it doesn't mean you have to follow it. But at least you have tools. And better than that, when you'll see a lot of these techniques and things done by the other side, especially if you have any private equity anywhere involved in your deal. So then you have to decide, so when or why do you need this? So what's the point of these term sheets? Well, it's really trying to get everything flushed out. And there's going to be lots of verbal conversations. There's going to be things that people promise, but the only thing that controls is whatever is in that document. And yes, it is non-binding, but there's a rule of etiquette, back to rules of the game. You don't get to change the term sheet once it's signed. And if you try, the other side will often yell at you. They may walk away from the deal. It's called a retrade. It's one of the terms of art. You do not get to retrade. And so this becomes the skeleton for the definitive documents and for the terms. So a giant mistake is you throw this thing together and it's missing things and you put extra stuff in, or you think you'll fix it later, you don't. So you're trying to reduce any confusion so that everybody's clear. For me, the second point's one of the biggest. So I am trying to get to a non-starter as quick as possible. This whole fundraising exercise is exhausting and it's time consuming, and you really don't have time for it, but you got no choice to do it. So you want to find out as soon as possible if the deal's going to happen or not. Because if it's not, you want to get away from it. You don't, often I'll have a client that'll say, well, they've got some wart they don't want to talk about. I said, not get it out there, because if we can't get by it, you're going to be 3 months into this exercise. They're going to come across the wart during due diligence and they're going to walk on you, and you just blew 3 months thinking, well, maybe if they see it later, they won't care. And so you're trying to get everything out there, and this can help flush out those non-starters. If you've got a very strict term that you're going to require, and you can get it in the term sheet. So what is a term sheet? It's mostly thought of the outline, but go more with what I said before. It's really the key to the deal. It's the anchor of the deal and what's going to get followed. Don't do it yourself. That's whatever you do. It's a big mistake. I'll come up with it on the mistake page, but don't try to do the term sheet yourself. Don't get ChatGPT does terrible term sheets, by the way. Please don't use that. There are some you can pull, but they just don't work. Excuse me. They don't work. So you got to get help from somebody to put it together. As a lawyer, my most hated thing is somebody says, oh, will you help me with my financing? We've got a signed term sheet. And a giant sigh exits, because I know I'm against the wall, and so's the client, and I don't know where we're going to end up. Avoidable problems. You've got to know the terms, you got to know the terminology, and you can't misuse it. Misusing that stuff, makes you look stupid, but worse, it can confuse the deal. And so you throw a term around that you think means one thing and it means another. It ends up in the term sheet, and oops, I thought pro rata meant something other than it did. So you watch that. We talked about you have to decide what to include and not include. You need to be careful not to put things in that is going to make your investor angry. They're going to put things in that are going to make you angry, I promise. But you don't get the privilege of doing the opposite. So if you put things in there that are not according to the rules of the game, they're very likely not to play through with you. So the same as putting things, if you miss things, if you don't communicate well, you just drop the term sheet without preliminary conversations about the terms that are in there. And this is a big one, if you don't understand, sorry, did I hit a button accidentally? If you don't see this from the investor's perspective, and a lot of that's understanding what the investor wants. Different rounds have a different expected percentage that investor's going to get, and the deal's going to reflect it. There's certain terms, there's certain things about an option pool they expect. And so you need to know what they're doing and why, because they're trying to get a multiple. And they're expecting, depending on where they are, they may be expecting to get 10 to 13 times their investment. And not really understanding the reason they're putting the money in. They are not putting in the money to help you because they like you, because they think your tech is cool, because they think you're a good person, because they're hoping to double their money. No, they have a very specific need. And you got to get in their shoes to understand it and negotiate the stuff out. And then the last one, if you start doing things that are unusual, unorthodox, it will go bad. So there are terms upon terms, but I'm gonna point these out a little bit, talk about a few of them. And the point being there's two sets of terms. There's ones that you're using in your communications that are like shorthand and that they're going to use. And then there's the other set that show up in the documents. And then there's the ones that don't show up in the documents, but that are in the term sheet, sorry, but will show up in your documents later on. And you want to get the whole bucket of them. So so I like to say there's some things that ChatGPT and the AI models are terrible with. One of them they're great for are these words. So you pull up this stuff, you're going to get a 98% correct answer on, hey, what's the difference between pre-money and post-money? or you get really great on the fly answers. So what's great is that means you don't, it used to be a lot of work if you were green and didn't know what these words were to try to get current on them. Now you can practically do it while you're on a call if you're on Zoom and sit there and pull it up while you're going through it and make sense of it. But I'll talk about maybe a few of them. I'll just cherry pick that are maybe particularly relevant. I mentioned the word retrade. It's foreign, but if you do it, they're going to use that term and they're going to get angry with you. And you don't want to hear them say it because it means you messed up. The notion of expensive money is something to understand. Is this money that you're taking is all the cost associated with you giving them that money. And so it's not just the equity, it's the control. Let's see, I'll pull out some others. The top one on the right side, these things called protective provisions. They might be called that in the term sheet, they might not. These are things that investors come in with that it is a fancy way of saying, I, the investor, get veto power over the following items. And they construct it in different ways about how they obtain that, but there is a well understood standard set of protective provisions that are not very negotiable depending on how much money people are putting in. But it is super important to get on top of those before you get in the game and understand what you're going to give up. The key one being you will not be able under any circumstances to sell the company unless they agree to let you do it. So you could get the greatest deal in the world and they say no because they're not getting their multiple and there's nothing you can do. And so it's things like that in the protective provisions that are very important to understand. So there's a fantastic full chapter with tons of it in that Brad Feld book that I recommended. It's a good one to work from to understand what are the trade-offs, where can you nudge a little bit, but it's a must know. Checking my time. Okay, let's see. I'll go down. Oops, gotta keep hitting the wrong buttons. Another one that's interesting is use of funds, which you might hear and you might not. And often in the term sheet, or I've seen it sometimes not the term sheet and it flies in later, is the investor wants to control what you do with the money, which you think sounds reasonable, but once you start to unpack it, it can be very sticky. And it's one of those things I find that comes up a lot after a deal closes of your use of funds is to do the following things. And then you decide, oh, well, I'm going to pay down the credit cards. No, I didn't tell you could use the funds to pay down debt. Well, yeah, but it's good though, because there's all this interest accumulating. Investor says, I don't care because I need you to hit certain milestones for the next raise. So you keep incurring that interest. I don't agree to let you use the funds for that. So the use of funds stuff, which seems somewhat innocuous, is something you really have to look at and think about and discuss. And if it's wherever it shows up in the process. The no shop is an important one, and it has different ways being phrased in term sheets, but it's basically saying, hey, once you sign this, you can't talk to anybody else about doing any kind of a deal for X amount of time. And you obviously want that as short as possible. The investor wants it as long as possible, but some of the language around it can give a little bit of flexibility too. But in general, in a rules of the game scenario, once you sign that thing, you're locked in. Now, you might hear people say, and I say it a lot, hey, your best leverage as a company is having multiple term sheets, because then you have 2 different, 3 different, 4 different options to choose from. You can play them against each other to get the best deal. But often it doesn't work that way. You get one term sheet, you sign it, and then someone else shows up and they really want to do a deal with you that's different. You can't really even have a discussion with them. If you do, you get into all kinds of hot water. So those things are in there. They are always going to be in there, but you have to be sensitive to them and give them a second look. All right. I'm not going to keep an eye on the time so I can do the due diligence stuff. Anything in here I want to hit.
Craig, can you talk just a minute about participation? I know it doesn't come up all that often, but when it does, people can be totally unprepared for it.
I have a whole slide with diagrams on it coming up on participation specifically. So
okay. And then Tristan's asking whether the investors make the term sheet or the founder.
Well, let me go little casual on this. If I'm counsel to the company, I always want to do the term sheet. And The reason is I want to anchor the terms in my favor. If savvy investors will often try to do the term sheet, some of them will insist on doing it. That isn't what you want. There's some times you can't control it. It's certain types of deals where they'll say, okay, well, we're going to send you a term sheet because this is how we do the deals, and that's all there is to it. And the one with the money calls the shots, though. So unless you're OpenAI, and then you call the shots, but let's assume we're not, and so you're probably the one that's going to do it. But that's a very good thing because you get to anchor the terms, and then they have to negotiate you away from a position, not the other way around. See if I want to hit anything on this. Some of this I'll get to the important stuff later. Maybe the only thing I'll pull out of this is an information rights section. It's something that doesn't seem like a big deal, and it's a thing that becomes a problem later when you have a grumpy shareholder. So information rights will determine who gets to come and bother you for information, or who gets certain information at certain times, or certain financials. And there'll be this line about a major investor gets things and then others don't. And a major investor is someone who put in X amount of money. And this matters because, number one, you're really not going to want to be handing out this information. Second, whether they've signed NDAs or not, that information is liable to get out, somehow be slightly public or very public, or shared with somebody you didn't want it to be shared with. And finally, if they're a grumpy shareholder or they want to cause trouble, you don't want them to be able to easily exercise these rights that were part of their investment documents. You want them to have to go through the traditional channels under the law of whatever state you're in and force them to do that. So these information rights, which seem completely innocuous and reasonable, are oddly more important than you think they are, and should give some thought to that line. I don't want everybody with the ability to get all of this information. I only want truly major investors. So if I had a group of angels that came in and maybe there was a lead, and then that whatever that lead came in with the most, I might try to say, all right, well, that's the line for a major. The rest of everybody doesn't get this information. So there's a great way to get your arms around what all this stuff is. And these are these model legal documents. A lot of attorneys use them, even out of big law. Sometimes a term sheet will require them to be used as the baseline. They're for a certain kind of fundraising called the price round, which is where you're actually selling shares. But they are fantastic because they give you these bracketed options of, oh, well, am I going to do participation or not? And they give you the examples of what to choose from. But it's a great learning exercise, both from understanding how the documents are structured and what the terms mean and what the trades are. I always think it's good to go take a look at it ahead. It's super thick documents. Like they're almost overkill, but they're worth it. And there's a decent chance that investor counsel might insist on them being used, or that may be their very baseline they use. So there's lots of places to determine what's market. This is just an example of one of the things I just pulled it. Wilson does this every year. And then, so there are certain investors that like to have something called redemption rights, which is basically they can force you to buy their stock back at a premium at a certain point in time. And if you look at this and say, oh, well, let's see, for 2024 down rounds, what did these look like? Up rounds, what did that look like? Boy, that's not very common. So that is not a standard thing. And an investor might ask for it, but you're able to look at it and go, look, this isn't market. I don't like it. It's not market. You have something to debate about. That's not just, I don't want to be forced to give you money. You can say it's not market. So there's no one place that has all of this, although every law firm has their own that they've collected, that they know what market is. And it's a thing everybody keeps to themselves because it's an advantage when you're doing work. You can find it. And great, again, ChatGPT can provide some of this information. You can usually trust it. It's usually fairly right. Example, a good one is anti-dilution provisions. Occasionally, somebody will try to shove a full ratchet down your throat. Notice it says 0%. That's because it's never done. If you have an investor coming in demanding a full ratchet, you should run away because they are not a good player. There's something wrong with them. It's a giant red flag. But all of this market stuff can help. It's just you have to do some legwork to find it. Or if you have counsel, they'll just tell you that's market, that's not, that's market, that's not. Let's see, checking my time. Oh, good, I'm great. So let's see, negotiation thoughts. I mentioned difficult to amend. So I want to talk about this first, the second item, because there almost is no exception to it. You work backwards to get to the valuation in the case of stock, or a cap in the case of convertibles or safes. You're essentially asking the question, okay, well, if I give up 20% of the company for $1 million, then what's the valuation? And it's determined that way. It's never determined in the reverse. It's not, okay, well, the company's worth $10 million. Okay, as soon as that comes out of your brain, it's the wrong way to think about it. The valuation is just, and the cap are just these pieces of, they're like the numerator in a math problem, and that's it. But you get to them going backwards. So you'd say, okay, well, let me see. If I need to raise $1 million and I'm only giving up 20% of the company, then what's the valuation? And it's either, depending on how you look at it, for pre or post, it's $5 million. Okay. Well, does that mean my company's worth $5 million? No, actually has nothing to do with what your company's worth. It has to do with how much of the company you're giving up. So it's an unfortunate thing that the word value ever got put in there, but that's not what it is. So if you haven't internalized that, it's important to do it, because you could get really bogged down in this. Which then leads, it's one of those things you don't have to negotiate, because what you're really negotiating is the percentage ownership. It's just, you do it by math. Then mentioned this sort of before with the market, you always want supporting arguments. And it might feel like a game, but if you don't have any merit behind any argument you're making, it won't go well. And there are arguments for almost anything that can be made. Counsel can always help with it, but look for that. ChatGPT is good with coming up with arguments too. So know the comparables, know the market. I mentioned multiple term sheets. Disinterested party always has the advantage. You cannot look desperate. You cannot look like you're about to run out of money. The sad part there is, if they see your financials, they'll know. They can try to starve you out. But if you are disinterested, you win. So this is why you want to start raising money before you need it, because you have some leverage, because you're less interested. If you're about to run out of money, you may have to take the only deal that's on the table. And then you need to know what the investor likes. Part of it is the type of deal. Oh, it's a Series A, but the other is by working your own network. Hey, what do these guys usually take as a percentage, so that you know what you're getting into? Some are really going to drive you to a higher number that maybe is a non-starter for you, and you won't do it. Back again to not finding yourself in a deal that you can't do. Hold on, it's getting dark. I'm going to turn a light on here. All right, there we go, much better. All right, so let's talk about some of the provisions. I do the dirty, nasty lawyer picture with that. So one of these things that goes in, and it's an important question on every level. I don't know if it's the most important, but it's close, which is, what kind of securities are being offered? What's the deal? Is it a convertible note deal? Is it a priced round? Does it have warrant coverage? Is it safes? And some of these are more investor friendly, some are more company friendly, and some can be tweaked one way or the other, but it's a giant decision. And yes, you can make a very wrong decision. I'd even go so far as to say, for any deal you're doing, there is an optimal choice here. So it drives me to drink when I hear one of my companies going out ahead of having a discussion with me, telling people they're doing hey, we're going to do a priced round, or hey, we're selling shares in the company. And there's all these emails and discussions about selling shares. And I said, oh gosh, we need to pull that back. So there's games to be played with this, and sometimes it changes, but you may start with one knowing you're going to end up somewhere else, but you start at a certain point for negotiating tactics. So it's a big decision and an important term, maybe the most important term. I bring up the closing date thing because depending on that first decision is whether or not you can have multiple closings. Now, it may sound great. I would just love to get all the money on day X. Sometimes that's hard to do. And sometimes it can cause other problems. And sometimes because some people aren't ready, you end up getting delays and the money drags for some inordinate amount of time. And so the language in and around the closing dates is very important. And in this case, the example here is, look, we're going to have a first and a second closing because that's how this is going to work. But if it doesn't say that, then you get forced into a position where some investors may not come to the table because they can't make the closing. In the term sheet, you say something about the amounts being raised, and this is shockingly relevant to you in that you need to make sure that if you think you might want to increase it, that you can, but even more than that, maybe you don't want it increased. And the example being, let's say you're going to take $500,000 for 25% of the company. That's very expensive money if you do that. So you might say, look, I'm not willing to go up because then if I take $1 million on these terms, I've given up 50% of the company. So it's you want to make sure that things are written in a way that you have a say in it, or maybe something that's like, this is the amount, end of story. Because investors they do favors for each other, right? They try to bring each other in on deals all the time. And if it's a good deal, they might want to bring oh, look, we got to have this person in. It's just 100,000. Come on, we can do this. And I usually try to talk to the companies ahead of time before people are coming in with these extra money and those dollars look good and they make an argument of why you ought to take that 100,000. Already decide your answer today. Write it down on a piece of paper so that when that day comes, you'll look at it and say, I said I wouldn't take more than that. I'm not going to. I'll take it on better terms later. So the language around it, you need to maintain control on it. This kind of goes to the same thing about adding investors, who the investors are, how can they be added, who gets a say, and if they're added, is it mutually agreed to? It can often depend on sort of the type of investors you're putting, but if you've got a fund that's coming in with a lead, they're going to want to control what they'll call the syndicate of who comes in and who doesn't. So this language will vary a lot, but you got to be sensitive to it because if it could ice you out of the ability to add people that you might want to. Where I see it come up a lot is some strategic player comes in and you really want them in and you want them on the board and they want to put money in and the investor doesn't want them for some reason. And there's contention over it. So the ability to go back to the term sheet is everything because otherwise you're just going to lose. But if you've got something to lean on, then you have a chance. There'll be something in most term sheets about the board, if there's going to be no change to it at all, it should at least say that. But you'll have all kinds of things, and the language is very specific, and the singular words matter. Preferred director elected by holders of a majority of the preferred stock voting as a separate class. Well, that depends what preferred stock is defined as. Is it just this preferred stock? Is it all preferred stock? Is it the preferred stock of this raise and some bridge that's coming after? So, because the big control question and the governance question, a lot of it hinges on board control. And so as each member comes in, they're going to have, even though they have fiduciary duties to look at the best interest of the company, they're also bringing their own interests in. And so I look here and I'm like, well, let's see, what's the proposal? We've got the lead investors director. We got a preferred director. We got a common stock director. That's probably favorable to me. The chief executive officer, I'm on there. So we're 2-2, and then there's an independent. All right. So it's fairly balanced. I got 2 on the investor side, 2 on the shareholder company side, and then an independent. That independent's really important. Now,
Craig,
yes,
you're at 6:45.
perfect. Okay. So one of the things I'll bring up on this whole independent director point is you want that person named. And a lot of times it's like, well, we'll just deal with it afterwards. Well, that's not going to work very well because you're going to have an even number in a lot of cases, and you won't necessarily agree on that independent. You've got a little bit of leverage now just trying to get the deal closed. So it's something you want on here so you know what's going to happen to your board before you take this money and can't undo it. I'm going to say at least half the time, investors like, oh, we'll just figure it out later. No, don't push the other way. We're going to go find that person. Protected provisions, I won't go through. They're self-explanatory. You'll look at what's in here. I mentioned one, the first one, anything that has you ending the company for good or for bad, they're going to have veto power over. But you look at that and need to think about what these are and talk with counsel on any you think you can get out of. Different kinds of dividends will be in there, and they matter. And dividends, easiest way to think about it, just think of it like interest payments. That's not at all accurate. The analogy is bad, but that's like, look, I got to pay this money out. And just like if people loaned money, I'd have to give them interest payments. So this is given the example out of the NVCA. It gives you a look at what they look like. And so cumulative means they're supposed to come out at specific times and they're going to be added up and that person's going to get paid no matter what. That's really close to an interest payment. So it's things like that. But anything with dividends in there, you take a really close look at it because it's costly later. There's things about liquidation preferences. Won't have time to go into it. This slide might help if you look at it. It's one you can have a conversation with your favorite AI model to get a good understanding about it. But it is important. And there is usually, at a minimum, a 1x liquidation preference. The short answer is that means they get their money back before anybody else does when there's a liquidation event. That's the 1x. Anything more than that is a premium. And market is always a question here. What's market? 1, 1.5, 2, and then what's your condition? Then you've got a bunch of participation. These things called participation rights. These often, it's interesting about whether it shows up or not in the term sheet. It usually does, but I've seen sometimes where it just says liquidation preference. It doesn't mention what the participating qualifier is. And the shortest and simplest way to explain it is because I have certain choices on an exit as an investor. I can either convert my stock with all its special privileges into common and ride along with you, or I can take certain advantages off of the fact that I have preferred stock and leave it at that and get my preferences from it. And so it's a little bit complex there. But the key on this is if I've got a liquidation preference and it's at play, what happens after I get paid off from it? And if it's not participating, what that means is I'm going to get my liquidation preference and then I don't get to participate in the proceeds after that. The next one is, well, I get my preference. I get whatever that is, 2x, 3x or something. And then I get to participate, but only up to a certain amount. And then I don't get any more. And then you got full participation, which I get this liquidation preference. And then I get it. And then I get to participate forever after that. And I would say by far and away, non-participating is the dominant market play. But I haven't seen full participation in a decade, and I think I've only seen it once or twice. So you look at it, it's one of those that it shouldn't be an issue, is what I always like. Well, I'm not sure you have to understand it because you should be getting non-participating, but you have to see what it says in the deal and then do the math on it for the particular deal.
So Craig, Tristan was saying like, these are all included in a term sheet? Because you've covered a lot of ground.
So they're not all a big, I'm going to say it would never be the case that all of them would be there. There will always be a subset, but anything that I'm mentioning here could be there. And some of these are just a word, like participation is just a qualifier on preference. So but yes, that's why the term sheet's such a big deal. It looks like this simple 1, 2, 3 page document, and it's loaded. It's a loaded gun. So this might help if you're trying to get your arms around what does this mean and how does it work. I'd still have a conversation with your language model if I were you and have it explain it to you and keep going back and forth till you get it. Pro rata rights, get check time. Okay, I'm gonna start going fast. I think I'm close to the end. Pro rata rights is an ability for someone to continue to maintain their percentage in the company in subsequent rounds, which seems like a good thing, The downside is if they choose not to, it looks like maybe they don't have faith in the company. And then the other is maybe you don't like them and you don't want them around and you can't get rid of them and they're maintaining their position. I have a lot of that latter case, believe it or not. So, but it is a standard term. Pre-money, post-money, you can look up and understand. There's a lot of things around right of first refusal. This will often be in the term sheet in a lot of detail. And this, the short of it is to understand this goes to if somebody's selling something, who gets first right to purchase it? And if someone is outside the company is interested in buying, does everybody get to come along and participate in selling their pro rata portion of their holdings? So this stuff is standard, but there can be tweaks to it. And this is one I'd usually lean on the lawyer to do the identifying what the issues are and negotiating it if it needs to be. But a lot of times it's cookie cutter. Drag along, big deal, will be in there. And if it's not in the term sheet, it'll show up and it's assumed, which is if the company goes to sell, you get drug along, isn't it? If you're holding, it depends who it says here, it's like holders of preferred stock and the founders. If the board decides to sell the company, you can't oppose it. You get drug along with the deal. You're going to sign those documents. A lot of companies will not buy unless everybody, particularly the founders, sign. So that's drag along. There's a counter thing called tag along. I won't go to that. You can read here some of what the negotiations are that are around drag along rights, depending on what the party's interests are. Anti-dilution, you only need to know that it ought to be broad-based weighted average, and it shouldn't be anything else. And if it is, somebody's playing games and they need to stop. Do not try to understand broad-based weighted average. Once you see the calculation, you'll go, oh my God, and you don't need to. And there's some other provisions that you'll see, very common, easy to understand if you look them up. I don't have to unpack them here. But because we're running out of time, I won't be able to go too far into this of how does AI fit into all of this? And I tried to through this to say, hey, use AI to do this, use it for that, but it should not be doing your documents. It should not be doing your term sheets, and you shouldn't use it to review anything because it gets it wrong, and it gets it wrong bad. And so if you're just curious what it would say, that's fine. You want to infuriate your lawyer and run up your bills, run stuff through ChatGPT and then go, oh, well, I took that term sheet. Here's what ChatGPT said about your work. I fire people that do that because I don't have time and I'm just going to burn your money now having to justify why ChatGPT is wrong. So I would just really advise against that part of it, but for using it to learn or to make sense of stuff, it's great. All right, so got through that. Let me go to the due diligence one.
So while he's doing that, let me say that was a lot of terms and they are important. And that's why he's recommended the 2 books. If you get Venture Deals, you'll have to read it a couple times to absorb it all. But it is a great reference.
All right, so I can get through this quick. This is really short. Even though it usually takes an hour, it's short. So that's the truth. Okay, same disclaimer. Going to blow through the agenda. All right, so same, I think. So I've got this big hang up about Roadhouse being the most important movie ever. But so I peppered this particular deck with that, but I'm going to skip all the Roadhouse jokes and just blow through it. So due diligence, what is it? It's this audit of the company. It's determined that it's in theory for the investor to determine whether or not they're going to put money in. If you want to look at it positively, it's an opportunity for you to get yourself in order because everything they're going to be looking at are things you either should have been doing or need to now do. So that's a good view. Unfortunately, if the investor is represented by a large law firm, you're going to get the youngest brand new associate that's trying to prove to the partner that they're impressive by finding things that they think could get a red flag that actually don't matter. But so the process can be really unpleasant, but it varies. Sometimes it's super smooth. They just want to get through it. And sometimes they're looking at everything. So let's see through this, the whole thing. All right. So keys to success. I already talked about the investor perspective. That's even more true in the due diligence model is to understand and know and expect what they're looking for and why it matters. You need to be transparent. This is not the time to hide anything. There may be, occasionally there's one or two things that come up that you're like, this isn't really something that's part of due diligence. It's not the prettiest story, and I'm not going to go into it. And I'll give a good example. You and your co-founder are presently hating each other. If they have any sense that there's a founder war coming, they're not investing. So you don't say, oh, I just feel like I ought to let you know that I really hate Bob now. That you don't bring that up. But otherwise, in general, you're transparent. You're really not spinning much. You need to be responsive. They're going to be slow. You have to be fast. I always say, look, we're going to turn stuff same day, every time. If you got a lawyer that's not doing that, get another one. But a lot of this will be on your back, not counsel. Know what market? I beat that one to death. You need to know what an investable company looks like. So there's a lot to that. Mentors and advisors can help a lot. Say, hey, in this space, this is where you need to be and what your story needs to sound like in order to make this work. And this is what your C-suite should look like. And if you don't have that look, you're going to have trouble. Prepared means try to get on top of it ahead of time. Don't wait. You need to be someone that the investor wants to work with. That's this important thing. It takes a while to get your arms around, but people just won't do business with people they don't want to generally like and do business with. Even if it's a good deal, a lot of times they'll take a pass on it. Don't believe the nonsense that you're throwing out there. That's nonsense. Know what's nonsense, know what's not. Know that this is an exercise. And a lot of times I'll see founders start to believe their pitch deck and their 5-year pro forma slide and stuff. I'm like, look, that's nonsense. Stop. It's not real. And most importantly, yes, be nice until it's time to not be nice. The most important rule that came out of that movement. Right? Now, how will you know when it's time to not be nice? Your lawyer will tell you. So do I need to go through all of this? I just say read it. I probably don't have to unpack it. It's just really important to get the investor angle. And it's like I told my daughter when she was in high school, getting an A is about working your teacher. It's not about the work. And it's a bit of an overstatement, but it's really true in a lot of cases throughout this due diligence process is you're going to need to see ahead of time what's going to set them off. Like you might have investor that they are just radically obsessed with the debt you're carrying or something. And then you've got to figure out, okay, well, how am I going to work that angle? How am I going to show it to them? What can I clean up before I put it in front of them? It just varies. So the more you can know, the better your network in terms of what you can find out. Do your due diligence on them as much as they do it on you. Data rooms. This is shockingly important. I'll hear a lot of companies say, I'm going to put all this stuff in a data room, and then I'm just going to let investors see it. What's wrong with that? Well, number one, you don't tailor anything for anybody. You don't know who looked at what. If you have to change something, you don't know who looked at the old version that you're going to have to explain the change. And then they come back later. It's this whole notion of putting it in there and what you put in there and controlling it is super critical from the outset. And then being able to know who saw what and then manage those rights and don't let them have access one day longer than they're supposed to. Just I'll set up a Dropbox. Well, that's a good thing to say first, but then there's 20 steps that go after it. So what are you supposed to expect with this? You're going to be annoyed and you're going to be frustrated and you're going to be tired. And that's just how the due diligence process goes in most cases. Even at the angel level, it comes up. You're not going to close around in 30 days. If the investor says you're going to close around in 30 days, you're not going to close it in 30 days. Just don't have that expectation. Maybe happened once or twice in my entire career that we had a 30-day close. Maybe. And I'd have to really think hard about that. And then the last one, yeah.
Question.
Yes.
Do you find that most investors are prepared for the fact that they might lose on an investment, or are they all convinced that they will make a big profit on the risk?
They expect, well, so let's make it even worse. You're just a number in their portfolio. That's how relevant you are. And everybody in their portfolio is supposed to be able to achieve a large exit. And that large exit is supposed to cover all the other ones that became dogs and died. And so from a probability perspective, they expect you to fail. But they need the possibility of you having a giant exit, which that sets up the other point, which is if you took that money from certain types of investors, you don't get to sell the company for $50 million so you can make 25 million. No, they're going to demand a $500 million exit and they're going to drive you in the ground to get there. And you're going to fail at selling for a $500 million. The anecdote I always give is one of the startups that I was with, we got a $300 million offer from GE, and the lead investor on the board said, no, has to be a $500 million or nothing. And why? Well, because all the other companies in their portfolio had already failed except for two of us. And they said, one of you's got to have a $500 million exit to cover that so we can do another fundraise and have another fund. Otherwise, we're going to be a zombie. So sorry, nope. And that's how it goes. So they expect you to fail. But when I say that, it means they expect it on a probability basis, but they are going to push you and drive you only towards a giant exit, which may or may not be achievable.
Another question here.
Yes.
When considering an investment, what financial metrics or milestones make a startup stand out?
Oh, wow. That's a great one. Interestingly, it varies by time. Certain times it's all about growth and not about like there was used to be this joke. It was even in Silicon Valley. You don't want any revenue, then you can get measured. Revenue is terrible. Don't get revenue. Just get growth. If you have revenue, you're doing the wrong thing. There was a genuine time when revenue was a bad thing. There's other times where this was not that long ago. We want to see monthly recurring revenue of $80,000. That was this like line for a Series A for a while. Then there's what about being profitable? Maybe. It's gonna depend on who you're taking the money from, a bunch of other things, and then maybe comparables. So it's not a fixed answer. There's pre-revenue and there's post-revenue lives. And when you're post-revenue, there's a different set of metrics that are applicable. And then you have to figure out which ones for that time are the ones that you have to worry about. So, and for the space, like if you're not in a SaaS business, MRR might not matter. It might be something else that they're looking for. Maybe it's certain types of long-term contracts or some consistency month over month or something, or maybe it's seasonal. It just varies. But the question's right in that that's something you did to figure out straight out of the gate to determine whether or not you're investable. It's just that it's not a uniform answer. And it is certainly true that there are some things in certain timeframes in certain businesses that will be the end of your ability to get funded. That MRR of 80,000 used to be one. So you figure that out by, again, mentors, advisors, counsel will be able to tell you. But you probably figure it out by looking around and reading anyway. The last item on here I'll point out real quick, friends with Benedicts. My point of this is always that, and this investors just hate when I say it, and I don't mean it like it sounds, but they're not your friend. They're on the other side of the table. Their goal is not to make you successful. Their goal and interest is not you personally. They raise money. They represent the money of other people. They need to get a multiple back on that. And you are an expendable crew member, a Star Trek red shirt, whatever you want to think of it as, in order to achieve that. And they will sell you out to do it because they have to, because that's their job. And so you have to keep that in mind. It's great if you get along and you can work together. And if things go well, that's good. And they can be incredibly helpful, but they are not on your side of the table. They're just not. Sometimes your interests align, sometimes they don't. They'll tell you the interests align. That's part of the deal. Oh yeah, if you're successful, we're successful. Gross oversimplification. You're much smarter to regard it as friends with Benedicts. Let's see. I won't go through that because I'm getting close to the drop dead time. This is a big one. There's not one due diligence I go through where the company doesn't want to cross the fraud line on something. They want to misrepresent something, say something. They're scared of it. They're bothered by it, something. Don't. If you're in the gray area, you just can't do it. You have to tell the truth and be open and straight all the way through. Then penalties are severe. Your best case is you get sued and you get hit, you even get hit personally, and your D&O insurance doesn't cover you. In your worst case, you go to jail, like our friend here. So. Oh, let's see, due diligence landmines, same kind of thing. You're dishonest. You can't stop with the over pitching yourself. You're in due diligence now. You're done with the pitch. Let the pitch go. Now get down to getting through the guts of your company. So what'll happen in these landmines? So there's this very varied set of things that could occur. They can walk, they can use it to cut back on the numbers or change the percentage of what they're supposed to get or ask for warrant coverage or something. Because of the way you acted, it carries on afterwards and they don't trust you working forward, and or they go so far as to try to replace you. It can just get bad. So all this stuff shown here. So I'm so close. Talk about anything here. I'd say the biggest thing on that here, maybe the two biggest, are the founder discord and the inconsistent storytelling. You keep telling something and then you tell something else. And that happens a lot where you gave a deck out early and the investor goes away and then they come back later and they're interested and they see a different deck with a different story. That can just blow everything up. And the other is if they get any sense of founder discord, they'll walk on you. They don't have time for it. Exclusives with no outs is one I probably should mention quickly. Is when you're young as a company, you'll often get cornered into doing an exclusive deal, but you don't have a way out of it. But that means you've given up the market for maybe a premium is less than you should have. So investors can get pretty upset with that and see that as a huge slowdown for what's otherwise required for market penetration. Churn's a big one. If you've got a bunch of customer churn in certain industries, but in most, it's a giant red flag, and they'll look at that closely, and there are metrics that they'll follow for it. Another nasty set of line main items, I put this a lot, is cap table issues. Depends on where you're at. If there's only two of you and you're brand new, you don't run into it too much, but it quickly develops. Oh, I've added some friends and family, and one of the four founders left, but they still have 12%. And oh, there's some people on there, they might be unaccredited, I'm not sure. And then, oh, there's some existing investors that I gave money to that had a full ratchet. So any of these things in here, the cap table looks like line items, but to an investor, they look at it and it looks like a landmine. And cleaning up the cap table is what the term is we use to deal with it. And sometimes you got to start that a year in advance to try to fix the mess that got made. Let's see. Another one, don't bother to check your trademark for your company name, and you get this really cool, clever name, and it turns out to be the same one that somebody else has. Your investor discovers that, and they walk away. And it happens during due diligence. And I had that happen to a company with millions of dollars queued up, and the person walked past another company with the same name in LA, called me on the phone, said, hey. So anyway, a bunch of other things that are listed there. And by the way, when I say these are landmines, what that means is you got to clean them up ahead of time. That's another way to put it, is if you leave these things standing there and you don't deal with them ahead, you won't have time during the due diligence process to deal with it.
I should mention that one of the things that both AngelNV and all of our other funds is we are not investing in LLCs. So you're going to have to convert to a corporation, a C Corp. And Craig, didn't we have one company that it just took more than a year to get that done?
Yes, I think it was because there wasn't money to close. It wasn't as much that we couldn't get it done. But I'll tell you where it gets tricky, and I think it might be the one we're talking about, is if you've got a bunch of investors in an LLC, you're going to have a heck of a time. It's very complicated and it's problematic, and there are tax problems with convertible notes, LLCs, trying to convert, all this. You think that seems really niche-y and nuanced. It is, but if you try to get the entity right from the start, and if you're going to go out and get money, you need to get out of that LLC structure as soon as you can. So, in this one, the first one can be a big deal, or not the first one, sorry. That's maybe think of something else. First one, sorry. The first one is not a big deal, but the key, what I was getting confused with was if you are selling goods in different states and haven't dealt with the question of tax in those various states, sales related taxes and things. And you get an investor that happens to be financial savvy or tax savvy, some of them are, they'll immediately go to that question. What's your tax situation in all these states? And you go, oh, I haven't really checked on it yet. You may not get to the money because it's going to take a while. So try to stay on top of whatever that is with your accountant so that you have an answer. The key here is having answers more than anything. The second to the bottom one, CIIAs are these confidential information invention assignment agreements. It's a super high line item in due diligence is, do you have ownership of all of your assets? Is every single contractor, employee, chief executive, advisor, anybody that touched anything signed an invention assignment agreement with you? Because if they didn't, they probably own it. And Nevada law is not all that favorable. So it's a super important thing to stay on top of. It's maybe the most common thing I see when we start. Okay, we're going to go do a raise. Let's start the cleanup process. Do you have CIIAs signed by everybody? No. Well, who do you have? Well, I got these 3 people, but these 3 people that quit, I don't have. Oh, can we get them? No, we all hate each other. Okay, this is going to be an enormous problem because those 3 people that didn't sign them own whatever they created, maybe. Now, if they were an employee, there's a statute that might help. It's a one-liner, but it's got problems and it's nerve-wracking. And so the simple answer is there are no exceptions. Everybody signs this. If somebody won't sign it, they're fired. They can't stay. They have to leave. If a contractor won't sign one, they're out. If an advisor won't sign one, forget it. If that advisor's contributed. So it's too important. Oh, and the last one there's important is that sometimes we say, oh, I'll deal with my finances and books and everything later. And then you find out how unbelievably time consuming and expensive it is to do. It's better to try to stay on top of it, as horribly boring as it is for most people. And then at the end of it, and I'll send this to, but you can pull it from anywhere, just sample due diligence lists. They vary a lot on the stuff that's in there, and they mix and match because in mergers and acquisitions, you also do due diligence and it's much more comprehensive. And so a lot of these lists mix and match stuff, but this one's pretty good to look through, give you a sense of it, but there is nothing that's absolutely representative. Every investor's due diligence list, if they have one, is different. They send it to you, they tell you to start giving them their stuff, and then the process gets started. And that's that. And I only went over by 3 minutes. So
That's correct.
okay.
So there was a question in here about S corps. And so what is the problem with S corps?
It's not that it's a problem. So an S corp's applicable. First thing I tell people is it's not an entity, it's a tax election. So if you're an LLC, you can elect to be taxed as an S corp, and then that has certain tax advantages in certain situations. But it's very limited in that, okay, well, you can't have a foreign investor, and entities are not allowed to be investors or members, or however you want to look at it. And so they've got all these restrictions around them that, yeah, you can be an S corp and you can get certain tax advantages, but then you're limited in what you can do. And in most cases, by the time a company comes to talk to me, they started out as an LLC, them and their friend or whatever. They made the S corp election, and now they're ready to raise money and do other things and get investors, and they're turning into a corp, a C corp, and the S corp thing goes away. So it's really only if you said, okay, well, I'm going to be an LLC, I'm going to be taking investment, and then it's a very tricky question. But that's such a small number of those that I deal with. So.
Okay, so Tristan suggests that we want separate entities, but I'm not sure what she means by that. Paying yourself as an employee, correct? You don't have to pay yourself.
Why would you want multiple entities?
Yeah, Tristan, if you want to unmute, you can clarify this question.
Sorry, can you hear me?
Yes.
Go ahead.
Okay, I have a trucking company as well, and we have a C corp under our trucking company. And the way that our accountant explained it is it was 2 separate entities, and that's how we pay ourselves as an employee when taking from it. So it acts as like 2 separate entities where it's the company's one and we are like separated from the company to pay ourselves?
So I would say for the most part, it doesn't end up being a legal question. I used to work in-house with a company that were two companies, and money moving different directions and dollars going out to different employees in one direction, and they're a contractor in another direction. And it was almost purely accounting related. There were some legal documents that we would do to make it work, but there wasn't really a legal component to it. So if your accountant's saying this is the way we want to do it, that's probably the way you want to do it.
Okay,
And
thank you.
when it comes to tax and accounting, I very much defer to them. There are some tax law related stuff that comes up, and your counsel can flag that. So, okay, there is a legal component to this beyond the pay grade of the CPA. But for the most part, I'll look to what the accountant or the CPA will tell me and say, okay, here's what we think we want to do. But with one exception, if you have a CPA that's just continually harping on you ought to be an LLC, you may want to find other counsel in terms of an accountant, because it means they may not be that well versed in, if you're going down this fundraising route and doing these things, the reasons for an LLC don't apply anymore, and they should know that. So every once in a while you'll come across something where, wow, I can't believe my accountant doesn't know that. Like, they didn't know that I had to pay a Delaware franchise tax. They should know that. If they don't know what you're talking about, then, or if they go and they look and they say, oh, well, I've got to pay a Delaware franchise tax because I'm a Delaware corp, and it says I owe $100,000, and they freak out, then that's a problem, because it's a simple checkbox that turns it into $400. So you just have to make sure you've got the right advisor. But in something like this, in playing these games with how employees get paid, how money moves from one entity to another, the accountant or your internal CFO type calls the shots.
Okay, yeah, we had to change from the LLC to a C corp.
Great.
Yeah.
And
Thank you.
Tristan, I know that the business that you're wanting to start is completely different from a trucking company.
Yes.
So separate C Corp for that.
Yes. Very different.
Okay.
And
All right.
the main legal counsel first comment there would be is maintaining excellent separation between everything is key. So it's way too, now everybody's like, oh, don't intermingle funds. And that's easy to avoid. It's a lot of other stuff. Oh, well, I'm sharing computers and I'm sharing this and sharing that. And if you start down the sharing route, then that company I gave you the reference I said that I was in-house for, we shared everything. And we actually had lots of documents back and forth that were suggestive of who owned what and who was a contractor, and if the equipment was quote unquote leased by the other, just to make sure everything was clear of where the lines of separation were on paper. Because it does catch up with you, in particular, if you are successful and need to sell the company, this stuff comes to bite you later. So you just try to say, all right, from the beginning, if I can provide some clarity on what falls on what side of what wall, it'll help.
Yes, everything's been very separated.
Perfect.
Thank you.
The company I went into did not do that, and we spent, no exaggeration, 3 years getting it all cleaned up very slowly. And then sure enough, when we walked in, it was soon after that we sold the company and everything looked perfect, but it took 3 years to clean up the mess they made. So
I will try not to make any mistakes.
oh, you can make mistakes. Just try to not make too many.
Other questions? Okay, Craig, thank you so much for all of your time tonight and shifting to doing 2 presentations instead of 1. Really appreciate it. The sample due diligence request, was that an NVCA? Because we actually share the due diligence questionnaire that we use in AngelNV
Okay, that's fine.
with you guys, because you're
yeah.
going to see it again if you get to the finals.
There's nothing special with this. I think it might have been from Wilson. I don't even know where it came from. I just pulled one day. So, oh, this one's pretty good. I'll just throw it at the end of this as an example. There's nothing special with it. You look at it, ignore it. Don't. If you've got one, you look at that. But yeah, I wouldn't say there's any particular reason to look at this one.
Okay. Fabulous. Here's how you can get in touch with Craig.
And I tell this to everybody when I do these talks. I'm always available to answer questions. I'm not going to do a bunch of free legal counsel stuff, but When you run into things, I always pick the phone up. And a 5-minute phone call sometimes can be worth a lot in terms of directing something. So if you're inclined, feel free to give me a call if you bump into stuff and feel like maybe I could provide some help or something. I am slowing my practice down, so I'm not trying to take on new clients. I'm just saying that. So they'd say, oh, he's just trying to get business out of me. Actually, the opposite. But I do like to provide help to startups. It's, as I try to tell people, my main role is to help you avoid stepping on landmines, at least the ones that are going to blow your legs off. And so you're going to make lots of mistakes. There's going to be lots of things that go wrong and lots of unavoidable stuff. But then if there's a few along the way that allow you to survive, it's like, gee, boy, I dodged a bullet there, then it's great. So that's why I said I'll always pick up the phone and try to provide a little guidance if I can. So.
All right, Craig, I'm going to give them your email address then.
Okay.
I'll have to look up your phone number. I don't know that one.
Oh,
All right,
here, I'll go
and
back. Let me, here, I'll
you
put
want to
this
share
back
that
up for a
slide
second.
again? Great.
Yeah, sorry.
Okay, I've put it in the chat. So, or you could just take a picture of it too. Okay, so we'll spin up the Disco community for the Due Diligence Bootcamp, and I'll make reference for all of those books. I also recommended the Power Law, Craig, in case they wanted to understand like fund metrics and dynamics.
Okay.
Plus the 2 books that you recommended. And then if you can send me the due diligence deck, we can include that one as well.
Okay, great.
All right. Thanks, everybody. Next week, we'll have Miguel Vasquez, and he's going to talk about the financial stuff that we look for in due diligence. Okay. Thanks, everybody.
All right.
Thank
Bye
you.
now.